want to turn it back to the jobs report today, and wanted you to take a listen to what the president had to say about the report as it came in just a short time ago. Take a listen.
This morning's report caps off my first year as president. And over that period, our economy created 6.6 million jobs. 6.6 million jobs. You can't remember another year when so many people went to work in this country. There's a reason. It never happened.
Okay, so let's bring in our guest now, Mark Hamrick, Bankrate.com, Senior Economic Analyst. Mark, thanks so much for being here on a Friday. Just want to get your reaction to this number. I mean, the White House originally said the number was going to be ugly, so even they got it wrong. How surprised are you?
Pleasantly surprised. I know the president probably is grateful that he didn't have to issue the same statement after the ADP report earlier in the week that came in with that negative print of 301,000. But, to sort of piggyback or at least to play into the theme that you referenced earlier about the collision of interests at some level between Wall Street and Main Street, let's think about the environment that we're in, where there's such volatility and uncertainty. And we're still in a record low interest rate environment with the $8.8 trillion on the Fed's balance sheet. Those things are abnormal, right? And yet we see high levels of inflation. Next week, CPI may beat the 7% year over year gain that we had seen in the previous reading. So high levels of inflation, high levels of liquidity, and yet strong jobs creation. And so these things do need to align. And I think ultimately it's going to be a positive thing if we can get to something that is nominal and more familiar than what we've been experiencing recently. And the next iteration of normal or nominal is going to be obviously different. But I do think that broadly, the economy is being transported to a better place. And obviously key to that is the resolution of the questions: how do they turn out this year, both the pandemic and inflation? And the answers to both of those are still very much up in the air, a lot of uncertainty.
And Mark, the gains were pretty broad-based. Just breaking them down a little bit, leisure and hospitality gained 151,000, 108,000 from bars and restaurants, professional business services up 86,000, retail up 61,000. So those gains were quite broad-based. Wages rose by 0.7% to stand at 5.7% year over year. What is all of this really telling us? What message does it send? And does it tell us that the Fed is well behind the curve?
I think we knew the Fed was behind the curve. This is simply a further affirmation of that. And I think the Fed takes that quite seriously at this point. We'll see how much in the coming commentary and obviously at the March 16th meeting. You're right. Great distribution, essentially, in terms of the sectors that are represented here. I think construction might have been one of the underperformers broadly. And we know that from the JOLTS report recently, which is a snapshot from the end of December, that we're at or have been at near record levels in the sense of job openings, near record levels with respect to those who are quitting jobs. And yet, sort of going from 8:29 Eastern time to 8:31 Eastern time this morning, all of a sudden we've seen the creation or addition or recovery of nearly 1.2 million jobs in the last 3 months that we didn't know we had before. The revisions that Jared alluded to earlier don't really change the picture that much for all of 2021, but it does suggest that the momentum that the economy had in the fourth quarter of last year is much better than what we thought, and obviously also then carrying on through to January. And ironically, now we're left with the question is, well, can that momentum carry on through February? And if Omicron does release its grip, if the pandemic does the same, then I think we have a reason to be optimistic about the current period and beyond.
So many analysts were saying that maybe we don't take this jobs report into consideration. We throw it out the window when the numbers were supposed to be softer. You say the Fed is definitely, obviously going to look at these numbers. So my question is, if the Fed is taking these numbers seriously, when we do get our rate hike, could it be a 50 basis point hike instead of a 25 basis point hike?
Well, I think that's a question everybody's trying to grapple with. And I don't know if I get extra points for being early but wrong on that. But I think also Chairman Powell and his colleagues want to do what they can to help to promote financial stability. And so it's not going to be helpful if they surprise markets. I think at this point, it's different than trying to help a moribund economy as we saw at the early days of the pandemic or back during the great financial crisis, when a big move in interest rates, meaning to the downside, was essentially like applying the paddles to the chest of a dying patient. I don't think that is necessarily tremendously useful in this environment. Obviously, interest rates do need to get to a higher level. The balance sheet does need to get to a lower level, and accommodation probably should have ended a while back if financial markets and the broader economy could tolerate that. But it's obviously the fact that we're discussing it, and I do think that we align with reality in these discussions, that it's on the table, and it'll be something to listen to in terms of commentary from officials, as well as how the future measures of inflation present themselves. And I think that there's one takeaway that I've sort of had to come to terms with, and that is that the supply chain issues do not seem to be resolving themselves as quickly as has been hoped. And, we've been talking about that for months now, and I still think that that's going to be a work in progress for much of this year.
Yeah, those supply chain issues showing up in earnings that we've seen and moving into the next quarter as well in guidance. I want to ask you about labor participation, because there was a slight uptick, 0.3% to 62.2%. Who's coming back and who's sitting out?
Well, we had good participation improvement on the part of women, and we know that in a sense, they bore some of the brunt of having to move to the sidelines early in the pandemic for a variety of reasons. And so that's what we welcome. But ultimately, we want not only labor force participation to get back to a higher pool of available workers to help satisfy the need to attract workers with that high level of job openings. And obviously, we see that through rising wages, but we still have the wage gap between average hourly earnings and the inflation rates. So we hope that further progress can be made. I think people have been a little conservative or pessimistic on that question. And I'm not saying that that's wrong, because we know there are some demographic challenges that have everything to do with older workers retiring from lack of legal immigration, and that's a federal policy shortfall that our elected officials in Washington may or may not be able to resolve given their widespread differences. But it is obviously an issue that has been troubling, and it's a demographic challenge not only for the United States, but for the Western economies broadly.
Okay, and I also thought it was interesting that aggregate average wages actually fell, even though more people are working. We will have to leave it there. Mark Hamrick, Bankrate.com, Senior Economist, Economic Analyst, thank you so much for stopping by.